The Producer Price Index, better known as PPI, might sound like a dry economic term. But in reality, it's one of the most powerful indicators of how healthy or fragile the world economy really is. PPI doesn't just track prices, it tells the story of what's happening behind the scenes in factories, on farms, in energy markets, and across supply chains. While consumer prices grab the headlines because they hit our wallets directly, producer prices are like the warning lights on a dashboard. They show where costs are rising first, before those increases spill over into the goods and services we all buy. In this video, we'll explore the Producer Price Index in depth. We'll explain exactly how it works and why it's different from the Consumer Price Index. Then, we'll walk through the dramatic historical shifts in producer prices over the last decade, including the roller coaster of the pandemic years. We'll look at the current state of PPI around the globe, compare the US, Europe, China, and emerging markets, and examine what experts expect for the future. We'll break down how different industries, energy, manufacturing, agriculture, and services each contribute to the overall numbers. And finally, we'll highlight the major forces shaping PPI today, from supply chain disruptions in energy markets to climate change and geopolitical risks. So, what exactly is the Producer Price Index? At its core, PPI measures the average change in prices that domestic producers receive for their output over time. In simpler terms, it looks at the prices producers charge when goods leave the factory gate or the farm before they reach the store shelves. This is what makes PPI so valuable. It captures price changes at the very beginning of the supply chain, long before they show up at the checkout counter. But how is it calculated? Every month, national statistical agencies collect price information directly from producers. They build a representative basket of goods and services that reflects the country's output. Everything from steel and machinery to farm crops and transportation services. Those prices are tracked over time and weighted by how important each product is in the overall economy. Importantly, PPI excludes things like sales taxes and retail markups. What you see is the raw price the producer actually receives. Now, one of the most common questions is, how does PPI differ from CPI, the Consumer Price Index? The answer is all about perspective. CPI reflects what consumers pay out of pocket, including imports, sales taxes, and retail margins. PPI, on the other hand, focuses only on domestically produced goods and services, excluding imports. CPI is heavily weighted toward items consumers buy every day, housing, food, healthcare, while PPI covers the entire economy's output, including business-to-business goods and capital equipment. The two measures often move together, but not always. Sometimes producers face rising costs they can't pass on, so PPI climbs while CPI stays flat. Other times, consumer prices rise because of taxes or import costs that never show up in PPI. That's why economists view PPI as a leading indicator. When producer prices climb, it's often only a matter of time before consumers feel it too. Over the past decade, PPI trends have told some fascinating and sometimes alarming stories about the global economy. In the United States, producer prices were relatively calm throughout the 2010s, usually rising only 1 to 3% per year, but everything changed during the pandemic. In 2020, as lockdowns spread, demand collapsed and oil prices briefly went negative, sending PPI down. Then came the rebound. By 2021, supply chains were strained, demand roared back with stimulus money, and producer prices skyrocketed. By June 2022, US PPI inflation peaked at more than 11%, the highest on record. After that, as supply chains healed and the Federal Reserve hiked interest rates, the numbers cooled. By late 2023, PPI growth had nearly vanished, only to tick up again modestly in 2025. Europe's story was even more dramatic. The continent experienced the same pandemic dip, but then the energy crisis hit. Natural gas prices soared after Russia's invasion of Ukraine, and by late 2022, European producer prices were up more than 30% year on year. In some countries, the increases were closer to 40%. It was an all-time record. But once energy prices fell in 2023, the index plunged into outright deflation. By 2025, European PPI had leveled off, essentially flat compared to the year before. China followed a different path. Its PPI boomed in 2021, rising more than 13% at the peak thanks to soaring coal and raw material prices, but this spike was short-lived. With a property market slump, weak consumer demand, and excess industrial capacity, China's PPI fell into deflation by 2022. As of 2024 and into 2025, Chinese producers have been cutting prices month after month, with factory gate deflation lasting more than 2 years straight. Emerging markets saw both extremes. In India, wholesale prices jumped more than 15% in 2022, fueled by food and energy costs. Turkey's PPI soared over 100% in the same year due to a collapsing currency. But by 2023, most emerging economies saw their PPIs fall sharply as commodity prices cooled, bringing some relief to consumers. Taken together, these historical swings show just how sensitive producer prices are to global shocks, whether it's a pandemic, a war, or a commodity supercycle. So where do things stand today? In the United States, producer prices in 2024 were mostly stable, even flat at times. But by July 2025, PPI was up 3.3% compared to the year before, showing that some inflationary pressure is creeping back, especially in services like transportation and financial fees. Europe, after its wild ride, is now in a calmer place. By mid-2025, European PPI was just barely positive, about 0.3% higher than a year earlier. That's a huge contrast to the double-digit surges of 2022. China remains the outlier. Its PPI is still negative, about 2 to 3% lower year-on-year as of 2025. With weak demand and too much industrial capacity, China is facing the opposite problem, deflation rather than inflation. Emerging markets are in a mixed position. India's wholesale inflation turned negative in 2023 and again in 2025, essentially showing no growth. Brazil, Indonesia, and other commodity-linked economies have also settled into very low producer price changes. Turkey, of course, is still battling extreme inflation, but that's more the exception than the rule. Overall, the current picture is one of moderation. The wild swings have ended, and producer prices are either flat or growing slowly in most of the world. Looking forward, the consensus is that global PPI will remain moderate over the next couple of years. The World Bank projects commodity prices will fall about 12% in 2025 and another 5% in 2026. That suggests producers will see continued relief in input costs. Oil and natural gas are expected to remain well below their 2022 highs, and metals should also ease slightly as global demand slows. Economic growth is forecast to stay modest, around 3% worldwide, which means demand pressures won't be strong enough to force big price hikes. In the United States, economists expect producer price inflation to hover around 2 to 3% through 2026. Europe is expected to see similarly low numbers. China may finally emerge from deflation, but forecasts suggest only very mild inflation, maybe 1% per year. The big risks are shocks, another energy crisis, new trade wars, or climate-related disasters that damage crops and drive up food prices. But absent those, the baseline scenario is stability. After the chaos of recent years, that's a welcome change. Producer prices are not all the same. Different industries tell very different stories. Energy is the wild card. When oil and gas prices spike, energy PPI explodes and drags the whole index with it. That's what happened in Europe in 2022, when energy prices more than doubled. Energy costs then filter into every other sector, from manufacturing to transportation. Manufacturing is heavily influenced by global supply and demand cycles. In 2021, shortages of metals, lumber, and semiconductors sent manufacturing PPIs soaring. By 2023, oversupply caused many of those prices to collapse, easing inflation. Agriculture is perhaps the most sensitive to shocks. Droughts, floods, or wars can send food prices soaring. In 2022, the Ukraine war and extreme weather drove grain and vegetable prices higher around the world, contributing to spikes in food PPI. By 2024, better harvests brought those prices down, but agriculture remains highly vulnerable to climate events. Services are different. They don't rely on commodities as much, but they do rely on labor. Rising wages push service producers to charge more, and those increases tend to be sticky. In 2025, U.S. service PPI rose at its fastest monthly pace in years, driven by higher trade margins and transportation costs. Unlike commodities, service prices rarely crash. Once they rise, they often stay elevated. Each of these sectors matters for the overall economy. Energy spikes ignite inflation everywhere. Manufacturing prices set the tone for consumer goods. Agriculture drives food inflation, which hits consumers hardest in developing countries. And services influence core inflation, which central banks care about most. Several powerful forces are shaping producer prices right now. Supply chains have healed compared to the chaos of 2021, but vulnerabilities remain. Any disruption, from wars to natural disasters, can still send costs surging. Energy markets remain volatile, with OPEC decisions, geopolitical tensions, and the shift to renewable energy all influencing prices. Trade policies are increasingly important. New tariffs, export bans, and geopolitical conflicts can raise costs for producers. In the U.S., recent tariffs have already added to producer price inflation. Labor and wages are another key driver. With tight job markets in many countries, wages are rising, especially in services. That pushes service PPIs higher. Climate change adds yet another layer of risk. Droughts, floods, and heat waves are already affecting crop yields and energy supply, driving volatility in agricultural and energy PPIs. All these factors show that producer prices are not just about economics, they're about geopolitics, climate, technology, and human behavior. The Producer Price Index might seem like an abstract number, but it tells us a lot about where the economy is heading. It shows the costs building up behind the scenes, long before consumers feel them. And right now, it tells a story of moderation after a period of historic volatility. If you want to understand inflation, interest rates, or even the future of global trade, you need to watch the PPI, because as producers go, so goes the rest of the economy. Thanks for watching today's video. I hope you found it helpful and insightful. If you enjoyed it, hit the like button and subscribe to Logistics ABC. Turn on notifications so you never miss out on future videos. Check out the recommended videos here for more great content. Thanks for being part of the Logistics ABC community, and see you in the next video.